So let's continue with part two of the Dow Jones. Those are the Dow 30 stocks. Let's start with Walgreens Boots Alliance. Well, presumably people are going to need pharmaceutical products. Still taking a bit of a whack. Now, it's gone back to 2013 levels. In actual fact, it's gone to levels that was back in 2005. And you might argue, well, okay, whilst it could fall further, there's not much reason to suppose something like Walgreens Boots would fall too far. I mean, it's presumably got essential items that they're selling. Sure, they might shut down on some of the sort of global expansion plans and so on and so forth. But really, does it justify to fall down to $40 from what it was at 8,000, let alone the fact that it was at 9,000? I think I can make 100% return on this one when it goes back to 8,000. Now, if that takes 3 years, that's 33% per annum. If it takes 4 years, that's 25% per annum, better than a bank account. Okay, if it takes a year, hey, 100% double your money. Walgreens going in the list of things that I am buying as soon as I get off this call. By the way, the value growth rating on Walgreens, my own algorithms tell me the valuation is positive as well. Growth has been positive. Obviously, that's looking backwards. Going forward, earnings might be an issue, but I think with the amount of money that's being flooded into global markets, Walgreens one of those where it just seems to make sense to get into it. As well, albeit you could argue, well, hang on, Alpesh, this is one which has been on a decline since 2018. If you think about it, even 2019, it's been on a downward slide. Let me put it this way. So why would you want to get into something which has been accelerating to the downside, and its falls have not been caused by the recent market moves? Because the recent market moves mean it's come from closer to 6,000 down to 4,000. Well, that's still a 50% return. Still a 50% return if it gets back up to the $60 mark from the current $40 mark. So it is still a 50% return on that basis. Now, Cisco is one that I've held for a while, got fairly slaughtered on because it had been rising so well, and that's fallen back a bit. Obviously, global computer system, blah, 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 blah. It's now at the levels it was back in 2008, and we know that if it can go as low as there, well, why can't it go even further? You might equally argue, well, it's at levels it was at 34. Why can't it just go up closer to $60? That may well be the case. It's fallen off a bit of a cliff. It's got a 6 rating. I'm going to continue holding on to my Cisco stocks because whilst, it might fall a little bit more, but it's one, again, I say for the long term, I think it's just so core part of the global internet that we need it. Travelers got a 4 rating. Let's look at this. Not something which is particularly making me excited to either way. I don't have a strong opinion on it. It's got a 4 rating. I'm going to move on past that. Nike sportswear, discretionary spend. You're going to be doing a lot less of that if you're unemployed and companies start closing down. So I am not at the moment looking to get into Nike, not least because I think it could easily fall a lot lower in any event. Why would it not? What is there to stop it? It's come off this year from about $10 to $73. It would be a 50% return to get back up there. But that was when the global markets were growing. Where are they now? You may well ask. Exactly. So why would I want to get into that? IBM, similar story to some of the others. Yes, it's come off a cliff, but it's been going downwards for bloody ages. And things hadn't been looking positive even before all of this had started. So you might want to get into it just because you're thinking, listen, you know what? I'll go back to a time machine, it's taking me roughly back to 2004. And who knows, maybe at some point they'll get back and double up from $97 to $205. So that's going to be from $100 to $200. It's going to double your money, but God knows how long it could take. Could easily take 7 years. That's a bit way too long for me. I'm going to leave IBM. Pfizer, pharmaceuticals. Come on, guys. We're all going to need a bit of pharma, and I'm sure there's going to be a lot more money spent on pharmaceuticals. But again, another company which had been on a bit of a decline, a bit of a fall for a while. I can see the declines could easily continue a bit more. It might stabilize and give you a bit of a return. I'm not saying it won't give you a return, but I'm not so sure. Let's do 3 more in this part. 3M, Intel, and Procter Gamble before we go and do part 3. So 3M, too much of a downward slide in any event for too long a period of time. Where does it get me if it goes what? It was already on a decline. This just seems like an acceleration of something which had already happened. So not really something exciting me. Intel goes into the same problems as some of the others. Look at it over the long term. What does it do? Not really much. Even if we go here, where's it getting us from 2018 levels? Going from about $45 to 68. Really, I don't see an edge, a reason to do that. But let alone people might be spending a lot less on computers and hardware for the foreseeable future. Procter & Gamble, some of its discretionary spend, remember, on this stuff, whilst we might use it for hygiene and the like, and it had been rip-roaring ahead. This is now at $101, and it was at, well, a little bit more, $127. So it's giving me a 25% return if it goes back up. It's actually been quite defensive, if anything. And you might say to yourself, you know what, it's a pretty good defensive play to get into Procter & Gamble, given the, it seems one of those which have been up, and up, and it's just been dragged by this alone, and it's almost certainly going to make those rises again. So I'm going to get into Procter & Gamble. And what was the other one? Walgreens boots. Those are the two I'm going to do at the end of this video. See you in part 3 of this video, where we will go through Merck, McDonald's, Visa, Coca-Cola, Johnson & Johnson, Microsoft, and Apple. Stay tuned, folks, for part 3. Better than a Netflix binge.